Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth right here in Singapore. If you're serious about taking your Singaporean investment journey to the next level, you'll want to hear this. You know what makes most Singapore investors fail? It's not lack of capital. It's not even bad stock picks. It's trying to control things they simply cannot control. Market crashes, inflation fears, even your neighbor's investment wins. These things consume mental energy that should be focused on what actually matters for your wealth. That's why I've distilled Mel Robbins' book called The Let Them Theory into 7 crucial points that will transform how you approach investing in Singapore. This isn't just psychology. This is practical financial freedom. These 7 insights will show you how to stop letting market emotions drain your investment potential and start building real wealth through mental discipline. Let me dive right into point number 1. Let market volatility be market volatility. The Let Them theory starts with a simple truth. Markets will do what markets do. Singapore investors lose sleep watching STI fluctuations. They check portfolio values 5 times daily. But here's what Robbins discovered. When you say let the market be volatile, you release control over something that was never yours to begin with. Think about it like Singapore's weather. You don't stress about afternoon thunderstorms because you know they're normal. Apply the same logic to market dips. Let STI fall 10% this month. Let REITs underperform. Let your colleagues' crypto portfolio outshine yours temporarily. This isn't passivity, it's strategic emotional management. Your energy gets redirected from market-watching anxiety to actual wealth-building actions. Research shows that investors who check portfolios less frequently make better long-term decisions. In Singapore's context, this means focusing on fundamentals rather than daily price movements. Point number 2. Let other investors' success trigger your growth, not your insecurity. Singapore's investment culture breeds comparison. Your friend bought Nvidia at $20. Your colleague's property investment doubled. The Let Them theory transforms this dynamic completely. Instead of letting others' wins create stress, let them inspire strategic thinking. When someone shares their investment success, practice saying, let them prosper internally. This releases the toxic emotions that cloud judgment. Then shift to let me learn from this. Analyze their strategy, timing, or market insight without the emotional baggage of comparison. Remember, Singapore's investment opportunities are abundant. One person's success doesn't limit yours. The property market, stock exchange, and even CPF investment schemes offer multiple paths to wealth. Other investors aren't competition, they're case studies for what's possible. Point number 3. Let market experts disagree while you build your own strategy. Financial media bombards Singapore investors with conflicting advice. One analyst says buy banks. Another warns of property bubbles. Traditional investment wisdom says diversify everything. The Let Them theory teaches you to let experts have their opinions while you focus on your personal financial situation. Stop trying to reconcile every market prediction. Let Bloomberg say recession is coming. Let CNBC predict bull markets. Let local property gurus debate HDB versus private property investments. Your job isn't to figure out who's right. It's to build a strategy aligned with your risk tolerance and Singapore-specific circumstances. This is especially crucial for CPF investments. Don't let analysis paralysis prevent you from starting. The default CPF returns already beat many active strategies. If you choose to invest through CPFIS, let conflicting advice exist while you make decisions based on your timeline and goals. Point number 4. Let your past investment mistakes teach, not torment. Many Singapore investors carry guilt from previous losses. You bought high-flux bonds. You missed the property boom. You sold STI ETFs during COVID lows. The Let Them theory transforms this relationship with past decisions. Let those mistakes exist in the past, where they belong. Constantly rehashing poor investment choices creates emotional stress that impairs future judgment. Research shows that dwelling on losses increases risk aversion to unhealthy levels. In Singapore's competitive investment environment, this emotional baggage becomes expensive. Shift from, I'm terrible at investing to let me extract lessons from this experience. Your high flux loss taught you about credit risk. Missing property gains revealed the cost of analysis paralysis. Every mistake contains valuable intelligence for future decisions. Point number 5. Let family members have different money values. Singapore families often clash over investment approaches. Parents prefer fixed deposits. Children want growth stocks. Spouses disagree on property timing. The let them theory prevents these differences from derailing your financial progress. Let your parents stick with savings accounts if that gives them peace. Let your spouse remain skeptical of stock investments. Let your siblings choose different financial paths. These differences don't require your emotional energy or constant convincing efforts. Focus your energy on modeling successful investment behavior rather than converting others. When your diversified portfolio outperforms over time, your results speak louder than arguments. Singapore's family-oriented culture makes this particularly challenging, but financial independence requires individual responsibility. Now here's something important. For even more detailed charts, deeper dives into the data, and a full written breakdown of today's topic, including how these principles interact specifically with Singapore's CPF system and local tax implications, make sure to check out our Substack. The link is right there in the description. Point number 6. Let economic headlines create noise, not investment decisions. Singapore investors face constant economic headlines. US-China trade tensions, regional inflation concerns, local policy changes. The let them theory teaches you to let news be news while maintaining strategic focus. Headlines are designed to trigger emotional responses, not rational investment decisions. Let Bloomberg report recession fears. Let local news discuss property cooling measures. Let social media debates rage about cryptocurrency. Your investment strategy should be robust enough to weather normal economic cycles. This doesn't mean ignoring fundamental changes. Monitor Singapore's economic trends for strategic adjustments. But daily news consumption creates emotional volatility that mirrors market volatility. Successful investors develop information filters that separate signal from noise. Point number 7. Let market timing remain impossible while you embrace consistency. The final application of the let them theory addresses Singapore investors' obsession with perfect timing. Let market timing remain the impossible game it always was. Except that you'll never buy exact bottoms or sell exact tops. This shift enables dollar-cost averaging strategies that actually build wealth. Instead of waiting for perfect entry points, let market fluctuations work in your favor through consistent investing. Singapore's developed financial infrastructure makes regular investing accessible through various platforms. Your CPF contributions already demonstrate this principle. Consistent additions regardless of market conditions. Apply the same logic to voluntary investments. Let timing perfection be someone else's stress while you build wealth through systematic accumulation. Now let me give you my personal take on this. Having analyzed Singapore's investment landscape for years, I believe the let them theory addresses our market's biggest psychological challenge: the control illusion. Singapore investors are high achievers who excel through control and planning. But markets operate beyond individual control, creating massive psychological tension. The book's core insight, distinguishing between controllable and uncontrollable factors, directly applies to wealth building in Singapore. You can't control STI performance, but you can control your savings rate. You can't control property market timing, but you can control your research quality. Most importantly, this theory helps Singapore investors navigate our unique cultural pressures around financial success. The social comparison aspect is particularly relevant here. When you release the need to control others' investment outcomes, you free mental energy for your own wealth building. My recommendation? Implement this mindset gradually. Start with one investment decision where you consciously apply let them thinking. Watch how it reduces stress and improves decision quality. This isn't about becoming passive. It's about channeling your energy effectively in Singapore's competitive investment environment. So we've broken down the let them theory, and I've given you my personal take on how it applies to your investing journey here in Singapore. If you found this video helpful and want to seriously level up your investing game, please give it a like, share it with your friends, and subscribe to the Investing Iguana channel so you don't miss our next insights. And for those who want to be truly ahead, our premium members gain exclusive early access to all our videos, often a full week before anyone else sees them. This means you get detailed analyses and urgent insights on major market moves directly to your inbox, giving you a significant head start. It's just $1 a month, less than a cup of coffee. Think of it as your consistent daily dose of financial fuel for smarter decisions, delivered before the masses. Ready to join the inner circle and get that early edge? Just click the link in the description below to become a premium member today. For your next watch, check out our deep dive into Singapore's CPF optimization strategies, where we explore practical ways to maximize your retirement wealth using similar psychological principles. Thanks for watching, and I'll see you in the next video.